Hello and welcome to this week's episode of Nucleus Investment Insights. The topic of discussion for today is when Goldilocks markets meet a Russian bear. On the agenda, we'll first look at the unfolding situation in Russia and the Ukraine. Next, we'll discuss the risks of a financial crisis, the risk of a recession, supply chain risks, and the retaliation risk. Next, we'll discuss the Fed's role in this war. We'll also explore potential China-Taiwan implications and the stability of the Russian regime. And of course, as always, we'll cover the investment implications at the end. My name's Sam Kerr, and I'm the Senior Financial Advisor at Nucleus Wealth. Today, we just have Damien Klassen on the show. He's the Head of Investments, and he'll give us his expert insights on the unfolding situation. Damien, welcome. Thanks for joining us as always.
Thanks, Sam. Just me. That's the.
I should have said we've only got one guest today.
Yeah, that's right.
The star of the show.
That's right. Yeah. Thanks for that.
So just a quick reminder before we get started, if you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. Alternatively, follow us on your preferred podcast platform. Our show's available on all the majors. And for those of you listening live, feel free to drop your questions in the YouTube live stream chat, and we'll do our best to answer them during the show. So now we've got that little bit of housekeeping out of the way, we'll get into it. So Damien, I'll hand it over to you to get us started.
Yeah, sure. So, look, I mean, in the end, there's lots of other places you can go to for geopolitical views and I guess more detailed view about the war. I guess what we're really wanted to cover off on today was the investment implications for it, and what are the things that are going to flow from this down the track, not just in the next few days, but in the next few months and even years, in terms of how does what's happened sort of shape the narrative for markets, and how does it shape the effects on economies. So I thought I'd start with a quick sort of background in terms of just looking at where we are today. So I've got a map up here, basically showing where where Russia's made some inroads. I think the key thing is they do seem to be bogged down relative to what some of the expectations and certainly I think Russian expectations of what would happen. So they took the Crimea sort of 5 or 6 years ago. They took some of Georgia as well, and in both cases it was pretty much they walked in and secured what they needed. It was relatively quick, and the population sort of folded or came straight back across really quickly, and so I think there was at least some hope within Russia that was what was going to be the case, and so the resistance has been far stronger than they would have wanted. It is worth noting as well that Russia is not that large of an economy. It's about the 11th largest in the world, but its military is one of the top militaries in the world, and so there's a bit of a disconnect, or there's certainly its military was perceived to be one of the top militaries in the world. So there's a little bit of a disconnect between the size and military strength of Russia versus the size of its economy, and potentially what this is showing is that there might not be as much of a disconnect as people thought. Maybe the military in Russia isn't actually as strong as they thought, or so that whole part of the Russia effectively went broke, or the USSR effectively went broke on military spending, trying to keep up with the US, and maybe that's faded a lot over the years, and it's no longer the military power that it once was. So, which might mean that this could last longer than sort of a couple of weeks. It's also worth noting that Russia's got a pretty active propaganda unit, and pretty successful over the last few years in terms of I guess it's only ever rumored and discussion about what's going about the background and speculation about what's happening, but it does seem that their propaganda unit has been quite successful at sowing discord in places like the US and a lot of and Europe, in terms of dissatisfaction with governments and sowing conspiracy theories and all these different I guess all these different issues that they're trying to create for democracies. The thing that it has shown, though, this war is that while they might be quite efficient in terms of sowing discord and creating distrust of the state, what they haven't been successful is at rallying their country behind them and actually sort of creating this Russia is all together and also creating the view in the Ukraine that here Russia's coming to save you. It's not it's not an invader, it's a liberator. Whereas, I think the propaganda war, they certainly seem to have lost that on a global perspective. The number of countries that have come together to condemn them and the measures that are being put on. And then secondly, the propaganda war within the Ukraine and even within Russia, that they there's protests right across Russia in terms of against the war, and so they're obviously not winning that propaganda side or the hearts and minds of people. And the one other thing as well in terms of noting that is that it's it's turned into what in say Crimea they walked in, pretty much took that area of land within a few days and then have managed to keep that without a lot of local dissent. Whereas it does seem as if even if they do manage to take a large part of the Ukraine, that there's going to be ongoing dissent and ongoing military action even within those parts that they've taken. So I think there's it's not going well for Russia, I guess, is the summary of where it is. I mean, although it's they've still got the overwhelming military strength, it's certainly not going anywhere near as well as what the last few have done. I guess that's the background to it. Then we want to sort of jump in and look really at what the major risks are, and there are some pretty large downside risks that we're sort of monitoring and trying to work out what's where are these issues. The first is a financial crisis. So we've seen Russian banks cut out of the SWIFT system. We've seen that the central bank in the Russian central bank has had its assets seized or frozen, and so the various systems sort of plumbing the back end of financial systems around the world are a lot more tightly integrated than people would admit, and there's stress points within them. So, my take is that I'm pretty sure that before these sanctions went on, that the major banks in Europe were visited, and these sanctions were discussed in terms of whether that would create any issues. And I do think central banks are standing sort of by the banks in terms of providing ready to provide liquidity, ready to provide support if this does start creating any issues. So I think from that perspective, they can still get it wrong. Like there still could be a bank blow up somewhere, but in the first instance, I think the odds of a financial crisis emanating from one of the major banks is probably relatively low. The more likely case is we get something like the LTCM, which is a very large hedge fund that sort of blew up in the late 90s, ironically on the back of a Russian debt default that wasn't expected. We've seen a number of different hedge funds cause issues in recent years. We had Archegos, only last year, or possibly it might have been 2021. Had some problems with GameStop and losing money. And so the issue is if there are hedge funds that are particularly leveraged to that area and particularly leveraged to ongoing, particularly leveraged to Russian assets, then one of those blowing up could create sort of a financial crisis throughout the rest of the system. So again, not a huge probability, but certainly certainly a very real one in terms of what we're watching. Other problems is there could just be plumbing issues in terms of the way Russia's reacting, what they're doing in terms of their central banks, how they're trying to get money, whether they're going to be selling assets and sort of sucking liquidity out of some areas and providing too much liquidity in other areas. and and causing issues in that. So whenever we have these relatively unprecedented events, certainly for an economy of Russia's size to be cut out of the financial system, and Russia's size and its level of integration with the rest of the economy, there's always this chance we could have some sort of financial crisis. So that's sort of your primary risk. Your next risk also is recessionary risk. So we're looking at high inflation around the world. We're looking at this big jump in energy prices. We're looking at commodity prices. Ukraine's a big exporter, or Ukraine and Russia as well are both big exporters of wheat. So potential for food prices to increase. Central banks are already at the lower limits, so there's not a lot they can do. They can sort of try and flood the market with liquidity again, but in the face they're also facing this high inflation and resistance internally as to what they should be doing. So they're sort of on one side there's high inflation, on the other side they want to try and prevent the economy from falling back. Maybe that's enough to tip the economy into recession, especially if we keep seeing the oil price rise, because that's effectively a tax on consumers, and it just leaves them less money to spend elsewhere. So so recessionary risks, supply chain risks. So we've seen that we're obviously the COVID and the shutdowns and a whole bunch of other factors really pushed global supply chains to the limit, and they still haven't recovered, and so they've been locked up for well over a year now, and the discussion was already that it's going to last into the second half of the year. This whatever time the supply chain was going to take to sort of unravel, this has just added more time to it. So they are, both Ukraine and Russia are big suppliers of commodities. That's going to have that flow down effect down that supply chain of you can't get the commodity that you need to produce it, and then so the next level's delayed, and the next level's delayed, and it sort of washes down the system. So so more supply chain risks sort of going forward. There's an overall one with inflation, and most of that is coming back to that supply chain, but also to whether what's going to happen is we'll end up with embedded higher inflation expectations. So we've seen a year's worth of inflation, and if that inflation had started dying off quite about around now, then it's quite possible that you don't get that embedded inflation into people's negotiations about wages and things like that. But if there's another wave of inflation of Russia and coming out of the Ukraine, then potentially what happens is people's expectations for inflation get embedded at higher levels, which means then they start asking for bigger price rises. Companies start looking to increase their prices more frequently, and you end up in that sort of upward spiral of inflation. So that's a very real risk coming out of this as well. Can you save yourself using crypto? So crypto is another. What does it mean for cryptocurrencies? So there's certainly going to be more demand coming out of Russia for people trying to get money out of Russia because they're locked in to use cryptocurrencies. On the flip side, there's going to be a lot more. There's going to be a lot harsher look at regulations for the crypto markets now. So mostly they've pushed back to say no, they're not going to regulate these assets. That's not what crypto is about, and that's the question of now. Does it mean that the governments start cracking down more on crypto, and also that that the idea for somebody in Russia who wants to get out of rubles, chances are they do genuinely want to buy something with it. So their first step might be buying cryptocurrencies, but then the second step is converting that cryptocurrencies into US dollar or euros or yen, and actually buying goods and services that they need, and so or goods and services to bring into Russia to sell. So there is sort of that two legs to crypto, is that it's not just sort of a buy and hold. For a lot of Russians will actually be about need to buy crypto but then sell it to actually get the goods on the other side, which isn't sort of price positive for it. There's a similar story for gold in terms of the Russian central bank has some pretty large reserves of gold, and so if they do need to start selling those, that's going to be negative for the price. But then on the flip side, will we have Russian citizens looking to try and hoard gold and try and get their money into gold to in order to escape some of the sanctions and for safety reasons as well, in terms of if there is more sort of problems within Russia, in terms of economic issues there. So the gold, and then finally on sort of these negative risks is this idea of what are the retaliatory risks that we could find from Russia, and probably heading that is the thought of cyber wars, or at least cyber attacks on, say, Western institutions, or Western financial institutions, or they might try and target some, particularly in the financial system, target areas of weakness in order to create problems for the for Western countries, and they've you've also seen some things they've been doing in terms of the in Russia, in terms of informing companies that not to pay coupons and not to pay, effectively default on debt. And so there's a reasonable argument. You're a Russian company that owes some interest payments, but you're locked out of the banking system, and so you can't make interest payments to your investors, even if you genuinely wanted to. And so there are sort of that flow on effects could be creating those, that comes back to that sort of financial crisis stuff we spoke at the top. So I don't know, I've rambled a little bit there, Sam. I don't know if there's any sort of questions on the.
Yeah, I just want to make one point clear, just to our investors and our clients. We don't currently hold any Russian securities, and we don't intend to hold any Russian securities going forward. So just want to let everyone know our stance on that. And we've also got a viewer question from MD, sort of on the other side of the coin. He's asking, how do we invest in Russia with brokers blocking trades?
That's a good question, with lots of risk. So I think this is the how do you escape the sanctions that I guess Western governments are trying to put on Russia? I'm not sure I can give any advice on there that wouldn't be a danger of being, any loopholes that are a danger of being closed, shortly after I give it. So yeah, I don't think I'll stray into that advice.
Fair enough.
But it is worth noting that we do, and part of that as well is we do have those ethical screens people can put on across portfolios to cut out any undemocratic countries, or any countries that sort of have financial repression. So yeah, that's a sort of, as part of our ethical screens, investors can do that explicitly, but yeah, no, we don't have that exposure to stocks listed in Russia for these types of reasons, that the risks are particularly high. Okay, so the next question then is the upside side. So we've seen markets bounce in the last certainly overnight, and rallying off the lows. Basically the markets fell going into the attack, and then as the attack happened, we actually saw markets rally quite strongly at the end of last week. So, a couple of different reasons why we saw markets bounce. One is that the initial sanctions were certainly less than what many had expected. The next round of sanctions were higher, but I think there's probably a sense of relief that some of the worst case scenarios haven't appeared as yet. So what I mean by that is that there was the potential that NATO could have been drawn into the war in very early stages, or the US drawn into the war, but at the moment that doesn't look like it's happening. And so the idea that there's some sort of risk premium in the market, or some sort of discount that you have to make on in terms of stock, for the fact that maybe there is World War III coming, and so still looks like a very low probability, but the fact that the war started and we didn't see the US step straight in, or Europe step straight, or NATO step straight in, there's probably a bit of relief within that. Once you get there, there's a lot of programmatic traders out there, and there's certainly been a huge rise in it since the programmatic and retail traders that tend to trade on momentum. And so what you find is that when markets start going up, they tend to jump in and push it a bit further. It's a bit like this pendulum, and then when markets are going down, they'll do the opposite. And so we are getting a lot of volatility, and so some of the trading need to be acknowledged that it's either quantitative programs that people have, or retail investors sort of just basically just chasing the latest moves and pushing them higher. Also within the way that the hedging structure at the moment, and so this is a lot about gamma and some of the more technical sort of aspects of plumbing. Basically means that the market makers, the people who take options trades, the way they're set up at the moment tends to be that they're exacerbating market moves. So sort of 5 years ago, given the structure of the options market and the way people were trading it, what would tend to happen is the market makers would basically be offsetting. So as people are buying, they're out there selling, which sort of dampens the market move up. And then when people are out selling, the market makers are in buying, so dampening the move down. Whereas we've ended up with this market at the moment where it's quite often the opposite. So market makers are buying to cover positions as investors are buying, and that sort of pushes that market extra in the upward direction, and then the same on the downside. So we have seen that, and it's worth noting, I guess, as if we do see volatility start to fall back, then there'll probably be more leverage added into the system. So there's a lot of people who, when markets get volatile, they de-lever, so they take away debt, and then when markets get a bit safer, then they start adding more debt to it. And so a lot of that deleveraging has already happened. If and when, I guess, volatility starts to fall, you'll probably start to see some of that debt sort of go back into the market. The biggest factor, though, what I've been saying is what I think is the biggest factor, and I think last night's movements, off the back of the U.S. Central Bank announcements, is that that more of the market is driven by what's happening on interest rates, I think, than what's happening in the Ukraine. The net effect really is that that Russia is the 11th largest economy in the world. The Ukraine's the 57th largest economy in the world. The US actually isn't directly involved in this. So there's at face value, there's sort of they're two economies that aren't necessarily going to bring down the world economic growth on their own, and without the US being involved, there would be a reasonable argument, ex the geopolitical issues, that the US central bank, it isn't really involved, and it shouldn't really need to change its expectations. So I think it's more about I guess, people extrapolating out and saying, okay, but we do live in the real world. There are geopolitical expectations. There are sentiment issues that are going to affect markets, and so the US central bank will need to sort of have some be a little bit less likely to raise rates than if there was no war. And that sort of flows back to this idea of reflexivity as well, which is another factor within these. And what I mean by reflexivity is sometimes market movements actually affect the real world, and vice versa. And I think in this case is market movements affect the real world rather than exclusively the real world only affecting markets. And so what I mean by this is when you get sort of booms in asset prices, often that means that then people get out and spend more money, and which gets the real economy going again, and then more money gets funneled into whatever asset class is booming, and that might, if it's, say it's a housing boom, that then creates even more action and more building until the whole thing finally tips over and goes the other way. And so in this case, though, I think the reflexivity is probably going to keep the upside to be limited. And the reason why is because we're looking at this US central bank, um, looking to raise rates to cut off inflation. If markets do rise and don't get too sort of caught up in the whole the Ukraine situation and fall to any significant extent, then the US central bank is more likely to raise rates because they're looking at two threats: inflation on one side and financial stability on the other. And if markets are rising, then the financial stability risk is low, and so therefore they can raise rates, which then sort of limits how much markets will rise. Whereas the flip side is if markets fall, then it's quite likely that the US central bank is more likely to hold off on rate rises, or at least do less than what they might have otherwise done, with the idea that financial stability is now a bigger threat than inflation. And so it's that reflexivity between the two that sort of will help, I guess, limit the upside and provide potentially a buying opportunity, if we do see bigger downside. So that's sort of one of the, yeah, that's how we're looking at these. A case where we have a number of risks which we ran through before, which relatively extreme, and then the flip side, not a lot of upside in the best cases, but a reasonable chance that if we do get some market falls, that the central banks will become more accommodative, and that'll actually mean that we're going to score some. There will be a buying opportunity at some point. So that's one. Then okay, so that's a sort of upside downside case. There's a number of other factors that this is sort of brought to light, and one of the bigger ones, other geopolitical issues. One of the bigger ones is the China and Taiwanese impact. So there's a relatively widespread view that China is really just biding its time and building up to at some stage make a play for Taiwan. I think China's had a preview of what the global reaction would be if it does decide to attack Taiwan. So I do think there's they will now be factoring that into their thoughts. China has some very, very large external reserves. They can now see that if they attack Taiwan, there's a pretty reasonable chance the West would go down the same playbook and seize those reserves, which then means it's very hard for it would be very difficult economically within China. The other thing is that you note that two countries, when countries go to war, and we're looking at a very integrated global economy. If other countries then start, you can see that if China attacked Taiwan, you might then start seeing boycotts of Chinese products. You might see, similar types of plays in terms of embargoes on certain products that can easily be produced elsewhere, and that can have a devastating effect on the Chinese economy. So I think that from a Taiwan perspective, the odds of a Chinese attack on Taiwan have certainly decreased substantially, given the effects, and also given how China can see how tied down the Russian military has been. It hasn't just been a walk in and everyone lays down their arms, similar to Crimea. It looks like being a much more prolonged war. And so, I think for China now, they've obviously got to see somebody else's reaction, and so that I think will temper their enthusiasm for war in Taiwan in the immediate future, at least. Not to say it definitely won't happen, but certainly I think the odds, relative to where it was prior to this attack have decreased.
Hey Damien, I'll just jump in there. We've got a viewer question from Sasha. She's just asking, how does the exclusion of Russia from SWIFT affect trade and prices in the EU going forward? And will this be a contagion with unforeseen consequences?
So I'll start with the second one. There's definitely a possibility of contagion, and unforeseen circumstances are almost certainly going to happen. The issue will now be whether contagion is allowed to get out of control, and so in some cases, governments just can't, and central banks just can't control it. It's in an area nobody was expecting, and nobody has a game plan for it, and it just it pops up and contagion and financial crisis ensues. I think in this case, it's more likely that they'll get on top of it in the early stages. So I think any of the banks where you're looking at contagion, there will definitely be huge liquidity lines from central banks given, almost without question. For hedge funds will be more difficult, because I think there's one thing about saying, here's a bank which had some exposure to Russian loans are defaulting, and so therefore we're going to bail them out to save the banking system and save the depositors. I think it's obviously a lot more difficult to turn around and say, hey, here's a bunch of rich hedge fund people managing money for billionaires and millionaires, and they've run into problems. Let's bail them out. I think that's obviously a bigger problem, and that's probably the most likely place we could get contagion from. The start of the question about trade and prices in Europe. Look, the big one is energy, and the way it's been structured in terms of energy basically being the only thing that's sort of been left out of the exclusion does sort of play into the it plays very well for Europe in terms of being their biggest danger is that Russia cuts off all the energy supplies. The problem for Russia is that's the only place they can get dollars. The ruble's already crashed. If they decide to, it'll be if they decided not to provide energy to Europe, then it's almost they're cutting off their nose despite their face. They're gonna end up with an even bigger financial problem themselves. And so it's relatively well designed, which is good. The problem though is prices will be higher, and which means more inflation. And it's a type of inflation. This isn't the good type of inflation. This is a type of inflation you can't really control with interest rate rises. It's due to scarcity. And so really, when you do start raising interest rates, which is what we spoke about with a lot of the supply chain issues, is effectively you're raising interest rates, which is basically smashing demand and preventing people from buying things in order to get it down to a reduced level of supply. And so that's quite possibly the way they will go. It is worth noting as well, and I've got one of the board slides, but I'll bring it in here because it sort of fits with this question. Is effectively Putin's put a global carbon tax on. So as an unintended consequence of this whole factor, we've now got a $20, $30 per barrel of oil carbon tax on oil, and the gas price, particularly in Europe, is up. It's probably doubled or probably double or even triple what it might be at other times, and so that's accelerating the transition to renewable energies. So so that's one more unintended consequence. Is that anything else on the? Oh, sorry. And the only other one with China is it's worth keeping an eye on the China Russia trade, because the Ukraine and Russia are both reasonable suppliers of steel and iron ore. A lot of it from the Ukraine went to China. So while that production is in the hands of the Ukraine, obviously that's still getting pushed out to anyone and everyone will take that. It's the exports, once that becomes under the control of Russia, can that exports be diverted to and assuming that then there's embargoes and sanctions that sort of stop the steel from Russia going out to say European countries, can China pick up on that and effectively you just re-divert a lot of these things around the world? A bit more iron ore goes from Brazil to Europe, and a bit less goes from and then a bit the Ukrainian iron ore that might have gone to Europe ends up just being diverted to China. Is that type of factor that could easily happen, but it all comes down to how much China will allow that to happen, and whether they're being pressured. They went from, I guess, standing not quite by the side of Russia, but certainly standing very close to Russia, to starting to distance themselves the longer this goes on. And so that is one more potential wild card in terms of seeing what the net effect will be on commodities. I think if you start to see that relationship break down between China and Russia, or you see it break down more, I guess, then commodity prices are heading higher. And the closer that relationship is between them, the lower the price that we're going to see in terms of commodities. It'll just be about commodities getting diverted to different areas. Which is actually, having said all that, it is a bit harder for gas. Russian gas is actually quite hard to divert to China. There's most of the Russian gas isn't liquefied, and so it runs on pipelines, and most of the pipelines they haven't got the capacity to send it all the way across to eastern China. So they can get it into northwest of China relatively easily. But the problem with that, and then they are building some more big lines, big pipelines there. The problem though is that northwest China is actually where China has all of its energy resources. All of its coal and wind power and a lot of its solar power is all out in that northwest. And so they can provide it relatively easy to the parts that don't need the power, but it's hard to get Russian gas across to the parts that do actually need it. So that brings us back to then the Russian regime stability. So the other thing over the coming weeks that'll be very important to watch really is the effect on the average Russian person, because interest rates sort of shot up. I think they were sort of close to 4% last year during the crisis, and now they're 20. Inflation is skyrocketing. The cost of imports has skyrocketed. So for some, the average Russian citizen, life has become a lot harder. Chances of going on overseas holidays, getting imports and exports and all that type of stuff has reduced dramatically. There's sporting and sort of social exclusion. It's going to start causing. I mean, it has already caused some significant damage, I would think, to Putin's support. His it's probably not an immediate threat, but the longer it goes on, you would think that in the medium term, in particular, this could cause some issues, and it means that whereas I think Putin was probably looked upon as one of the leaders in the world with the least to worry about, I think that the damage that's already been done would suggest that it's in his best interest to get an exit to this. That's sometime in the sort of next couple of months, because if it starts to drag out into 6 months to a year and longer, then quite possibly he's going to be having some internal issues as well. The issue is, what is his graceful exit, and it's very hard to see. I think in the early days of the war, there probably was one. That they'd obviously got some immediate wins, and they could have had some peace talks and sort of taken, say, some of the eastern Ukraine and sort of left it at that to come back later, and still being able to pitch it as a win. But I think the longer it goes on, it's going to be much more difficult for Putin to explain this as any type of win, and that's going to create just creates issues and question marks about the stability of the Russian regime as well, which could then be one more sort of left field problem, which could go in any direction. And so that could be terrible for the world. It could be a fantastic outcome. So it's too early to say what that how that could manifest itself. So that's the key things we'll be watching. We might go, Sam, maybe to the viewer question. I want to do the investment wrap up, but it might be time maybe to ask for sort of further questions.
Yeah, we do have one more viewer question we'll just touch on. So one of the viewers is asking, do you think that Bitcoin and crypto in general might be more heavily regulated if there's success at circumnavigating sanctions? And is it really possible to circumnavigate these sanctions?
Look, absolutely, it's possible to circumnavigate sanctions. It happens, North Korea and Iran and any number of countries like that manage to circumvent them. But it's very difficult to circumvent them in size. And the problem as well when it comes to that is Russia is a very big economy. So it is 11th largest in the world. It's very different to a North Korea or even an Iran. It's possible to circumvent things at the margin, but once the flows become quite large, then it becomes much harder to circumvent. So this is a if you're a cryptocurrency true believer, then you should at least be examining those beliefs. If there's some people who are in it saying, I'm just going to buy it and I'm going to try and run and stay ahead of the herd and do whatever I can. But if you're somebody who's like, no, I'm going to buy this and hold it forever, you want to be watching pretty closely what's going on, because there is enough of I think if there's widespread evasion of the sanctions by Russia, but using cryptocurrencies, then I think you could see a very good case for a lot of Western countries to start regulating them in a way that they wouldn't have otherwise done. So if you didn't have this war, the chance of having some higher regulation was always possible, but a lower probability. I think whatever probability you want to assign to the higher regulation, it's gone up dramatically in the last week. So watch this space.
Awesome. Thanks for that, Damien. So this is the last call for any final viewer questions before we get into the viewer implications. Just drop them in the chat below and we can answer them after this segment. So now we have our viewer question of the week. This is for viewers to have some discussion in the comments section over the coming days. So the question this week is, will the US Fed care more about inflation or keeping stock markets high? So feel free to post your thoughts and engage with us and some of the other viewers over the coming week. Damien, I'll hand it back to you for the investment implications.
Yeah, so investment implications. So the number one is this idea of this global carbon tax. And within energy, we've spoken a few times, and we've got a number of charts on our website, sort of showing the difference in cost between different ways of producing energy. Whether you're talking about coal versus solar power versus solar plus batteries, and so our sort of view on energy generally is, if you can get solar plus batteries to a low enough price, that's our sort of killer app, because that you can expand it dramatically. The problems of intermittency go away, and you end up for the large part solving your issues. Now in Australia, solar plus batteries is pretty close to hitting parity with at sort of normal energy prices. At the prices we're seeing in Europe at the moment, if those were the normal prices, then everyone will flip to renewable energy. In Australia, exceedingly quickly. If you looked at somewhere like the US, somewhere like California or Texas, that's very sunny, they would flip, straight away, because it's just so much. It's so much cheaper. Some of the northern states that have less sunshine might be a little bit more line ball, but at current energy prices, renewable energy makes a ton of sense, and is that's effectively that global carbon tax is going to accelerate that force. In terms of electric vehicles and oil, it's on a similar path. So this whole idea of electrifying and having a battery, ends up being cheaper than using oil, it is not quite true yet. So under my numbers, at the older oil prices, we're talking somewhere, if you're driving, and the thought behind this is, if you were spending, say, $5,000 a year on filling your car up with oil, and it would cost you, say, $2,000 to do the same with running off a battery. So you're going to save yourself $3,000 a year, but the battery cost is about somewhere between $6,000 and $10,000 for the battery, depending upon what you're looking for. So you're talking about probably a 3 or 4 year payoff at least, and for most people, that's not enough. That's not fast enough. And the issue is, the more you drive your car, the better that payoff is. So if you're driving your car 100,000 kilometers a year, then the payoff's already here. It's already cheaper to switch to use a battery powered vehicle. I think at sort of the 70, 60, or so that $50 to $70 range, that is around about 60,000 to 80,000 kilometers a year, which is still a lot more than most people would do. I think that really does need to drop, and these prices are coming down over time, but you would need energy, you'd need oil prices, probably around $150 to $200 before it starts, probably closer to $200 before it starts becoming a no-brainer to start everyone flipping across to electric cars for cost purposes. But this will accelerate that trend, and a lot of the battery savings actually doesn't really come in terms of the materials or the technology. A lot of it is just about the number that are being produced. So if you're producing 1,000 batteries in a factory, you've got a certain costs. If you can now produce 10,000 batteries in that same factory, you can bring your cost down dramatically. If you can turn it into 1 million batteries in that same in the same factory, all of a sudden your cost per battery just really starts to fall away. And just that learnings that people get, and the more just incremental changes. There's a 1% improvement on this supply line, and a 1% improvement on another supply line, and a slight reconfiguration makes them 2% more effective, and that's those changes just happen every year and improve the costs. So I guess what I'm saying is the carbon tax is here. It is genuinely affecting electricity production right now. I think electric vehicles, it's affecting at the margin, but it's not as much of a no-brainer. But it will certainly bring that period closer. And I think just energy security, I think on its own in Europe is going to even if you didn't have high prices, the fact that they've had the shot across the bows in terms of saying they need to sort out their energy security and not be reliant on Russia to provide so much gas for them, I think will be enough to really accelerate that push to renewables. So that's your first point. The second one is this idea that we've got asymmetric risks. So I wrote a piece recently just sort of talking about humans aren't particularly good at judging asymmetric risks. So on one side you have a lottery risk, so basically a very small chance of winning a hell of a lot of money, and a very large chance of basically losing whatever you paid to have that lottery ticket. Now, governments know how badly that people calculate that trade-off, that they actually regulate it really heavily. In most countries, lotteries are the reserve of the government, and you can't just go out and create a lottery on your own. They're very heavily regulated because of that maths isn't done very well. And on the flip side, you have sort of insurance where you pay somebody a little bit of money, and with a high probability of losing that, with a low probability that you'll get a windfall if something goes wrong. And so, and insurance companies, you add up, they're the ones that effectively take those bets. The combined market cap of those companies is sort of well over $1 trillion. So it's that idea that when you've got asymmetric risks, humans don't price them particularly well. And that's what we think is happening at the moment, is that we've got these asymmetric risks, a lot of downside in a few cases. We spoke about financial crises and the whole bunch of different range in that on that second slide of things that can go wrong, which creates sort of big downside. And then on the upside, there is some upside, and potentially you could even say that's you could mount a case that that's the probable outcome is a small bit of upside. But I think those risks are they're skewed, and it's a question about, are you sort of picking they call it picking pennies up in front of steamrollers at this point in time, trying to make some small profits, but there's this large sort of you're picking up a few coins off the ground, but there's a steamroller that could coming behind it that could squash you. And so keeping an eye on those asymmetric risks. We're still carrying, and we sort of wound back late last year. We wound back our holdings of equities, and we're sort of carrying 30% plus spare cash in order to looking for these buying opportunities, which we do think will come. But we're still cognizant that the risks are still quite high at this point. In terms of the stocks we're buying, there's a argument about whether you should be buying value stocks, whether you should be buying growth stocks, whether you should be buying quality stocks. Traditionally, when you see rising interest rates, value stocks often outperform in that market. We don't think this is the time, though. We think your value stocks, to a certain extent, have already outperformed from the energy side, but we think the risks now to the energy are as much downwards as they are upwards, or even more downwards than upwards, actually. There's chances of shorter term energy spikes if we have shortages and cutouts, but we think the medium term picture is that there's going to be a lot more production coming on at current levels, and a lot more switching away from fossil fuels. And then the other thing that often drives value stocks is that when interest rates are rising, is you've got this value stocks. A lot of the industrial type value stocks don't have very much control over their own prices, so they're basically price takers. Is that when we're actually talking about smashing demand to get it down to the level of supply, then you don't want to be a price taker in that scenario. You want to be somebody who has more control over your prices and can put up prices and hold those prices. And so so we're not really investing that much in value stocks at the moment. We're looking more for sort of quality defensives. And what I mean by those types of stocks is we're looking for stocks that are paying a decent dividend. You've got defensive characteristics, whether it be things like supermarkets or more less discretionary goods, more goods that people have to buy all the time. And then growth stocks. Basically, what we're trying to do at the moment is we're looking for growth stocks. Which growth stocks to buy and when. So we've sort of got a shopping list of the growth stocks we like. And whenever you get these events and you get a lot of volatilities, what we'll see is a lot of good stocks will often get sold down, particularly at the start of crises when you're seeing markets fall, is people sell whatever's liquid. And so we've got our sort of shopping list, and we're sort of going through those, and we've got levels where we'd like to buy the stocks, and if the stocks fall to those levels, then we'll be switching into those and picking up those growth stocks at quality growth stocks at lower prices. And so so I guess the net message out of that is that the Russia-Ukraine war is certainly important, but don't sort of lose track of the fact that there's actually much larger forces at play in terms of investment. We are in the net effect is it is the 11th largest economy attacking the 57th largest economy. There's so much more of the world out there, and so it's more of an issue of looking. I mean, central banks are still the key play. Will we see policy error? Will central banks keep supporting markets, or are they going to switch and focus on squashing inflation? And that's your real key risk going forward.
Thanks for that summary there, Damien. We've had a couple of questions come through in regards to the fall in ruble and Russia's energy exports. So we've got one from Sasha. She's just asking, does the spot pricing of gas in Europe simply neutralize the pain of a low Russian ruble on Russian energy export?
For energy, Russian energy exporters, they're rolling in it, like because the low ruble all of a sudden means they're getting more rubles for every euro, and so and then high prices. The Russian energy sector is creaming it at the moment in terms of profits. The problem they've got is the rest of the economy isn't. The rest of the economy is suffering. They can't get the goods. And there's things like Boeing, for example, is not supplying parts to Russian aircraft anymore, and so there's sectors where they're like, well, are we going to have to recreate some of those sectors? That's the danger, is that and the way Europe's designed it, so that it's very hard for Russia to cut off their energy supplies to Europe, because that's the only place they're making money. They're sort of not making money from any other sources.
Awesome. Thanks for that, Damien. So that almost wraps us up. Damien, just want to thank you for sharing your knowledge and your insights as always.
Thanks, Sam.
So we do welcome your feedback on the show, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the YouTube comments below, or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your personal finances, please go to our website at nucleuswealth.com and book a call with me or one of the team. So for those of you that want some more information about the portfolios that Nucleus Wealth offers, a great page to visit is our portfolios page at nucleuswealth.com/portfolios. You can view our tactical, core, and passive portfolios. You can see the returns, the fees, and lots of information on how the portfolios are constructed and managed. So you can see the tactical portfolios there. Also got the core share portfolios. So you can see core international, core Australia. You can also see the performance data there too. And then we've also got our passive portfolios there as well. So don't forget to like the video now. And finally, if you know of anyone that might get some value out of today's episode, we'd appreciate it if you can please share it with them. Also, if you'd like to see more of our previous content and episodes, head over to nucleuswealth.com/content. And to stay up to date with news from us, you can also follow us on all major social media. For myself, Damien, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.